So in our last class, we said the income of the taxpayer will be subject to tax wherever the income has been made. So that was what we said. And you remember, we also talked about what a Nigerian company is. We said a Nigerian company is a company that is registered and incorporated in Nigeria. That was what we said about Nigerian company. And we said a non-Nigerian company is a company that is not incorporated in Nigeria. That is, it was not established and incorporated in Nigeria. So by implication, the income of a non-Nigerian company will not be subject to tax in Nigeria. That's what we said. The income of a non-Nigerian company will not be subject to tax in Nigeria. So in our last class too, we discussed about registration of company and documents required to be submitted alongside. And that is, I'm going to forward this note to you so that you can have it. Okay. So now, when you talk about a Nigerian company, I've said Nigerian company is a company that is incorporated and registered in Nigeria. So by implication, that means the company would be subject to tax in Nigeria. However, a non-Nigerian company is a company that is incorporated in Nigeria. It's a company that is not incorporated in Nigeria, rather. So when you talk about a non-Nigerian company, such a company is not incorporated in Nigeria. Such a company is not incorporated in Nigeria. And there could be some reasons or situation where income of a non-Nigerian company shall be subject to tax in Nigeria. There could be some situation whereby the income of a non-Nigerian company will be subject to tax in Nigeria. Actually, we have about 5 ways in which the income of a non-Nigerian company will be subject to tax in Nigeria. Now, what are the ways? Number one, we said where a company has a fixed base operation in Nigeria, the income of that fixed base operation in Nigeria will be subject to tax in Nigeria. That is what we said. Number one, that's number one. Number two, we said if the company does not have a fixed base operation in Nigeria but habitually operates in Nigeria, what does that mean? When we say a company habitually operates in Nigeria, that means operating through a person in Nigeria to conduct business on their behalf. So any income that is attributable to that operation in Nigeria shall be subject to tax in Nigeria. We also said where a company maintains a stock of goods or merchandise, where deliveries are regularly made by a person on behalf of the company, to the extent that the profit attributable to the business or trade shall be what subject to tax in Nigeria. So we are saying that the company is not in Nigeria. It's not a Nigerian company, but there are situations where this company regularly delivers goods and services to a Nigerian company or to Nigerians. So anybody that is doing that, any company doing that, will be subject to tax in Nigeria. The next one that we talked about is where there is turnkey projects. Where there is turnkey projects. What do we mean by turnkey projects? That is a project that is one single project. Just for example, Julius Berger is a Nigerian company, although they have some entities in Nigeria, but let us assume they are not Nigerian company. Now, this Julius Berger that is not Nigerian company, we are assuming. If Julius Berger comes to Nigeria to construct road, to just deliver some things or installation, any profit attributable to that operation shall be subject to tax in Nigeria. That is what we are saying. Now, recently, according to 2019 Finance Act, government introduced what we call significant economy presence, where a company is significantly present in Nigeria through digital means. They are not in Nigeria, but their presence is felt through digital means. So we're now saying that any profit that is attributable to this company would also be subject to tax in Nigeria. Would also be subject to tax in Nigeria. Would also be subject to tax in Nigeria. Now, what are the situations where a digital transaction of a company will be subject to tax in Nigeria. This question, examiner usually asks it. They usually ask it. They will say, explain significant economic presence. Okay, when you are explaining significant economic presence, you are going to say that this has to do with foreign entity involved in digital transaction in Nigeria. And such a company is deemed to have significantly operated in Nigeria or present in Nigeria if the following occurs. Number one, the company derives an income of 25 million or its equivalent in other currency in Nigeria through that digital transaction. Number two is that the company uses a Nigerian domain name or registered its website using Nigerian website with Nigerian address. So we have said number one, the company makes 25 million as turnover, 25 million and above as turnover in, it could be in Nigerian currency or its equivalent in other currency. That's number one. Number two, we said the company uses a domain name that is .ng or register its website using Nigerian address. That will mean that the company is targeting Nigerian markets indirectly. So that means the company is significantly operating in Nigeria. That's number two. Number three, any action that you do to target Nigerian market by stating your price in naira, then even though you are not in Nigeria, but you state your price in Nigeria because you are trying to target people or persons in Nigeria to patronize your business. Then we said this company has significant economic presence in Nigeria. Facebook has significant economic presence in Nigeria. Yes, they are not in Nigeria, but they are present in Nigeria. Google are present in Nigeria. Twitter, present in Nigeria. AliExpress, when you want to buy stuff on AliExpress, some of them state their prices in naira. Okay, so stating the price in naira means you want to attract Nigerian markets. Therefore, that constitutes significant economic presence. So what are the examples of products or revenue that could constitute this significant economic presence? We say number one, streaming and downloading of digital content. That's number one. Streaming and downloading of digital content is number one. Number two, transmission of data collected about users in Nigeria. Transmission of data collected about users in Nigeria. That's number two. Number three, provision of goods or services directly or through a digital platform. Provision of goods or services directly or through a digital platform. So a person is not in Nigeria, a company is not in Nigeria, but transacting business with Nigerians through digital platform. Any service that links buyer and supplier together. Any service that link supplier and customer together shall be subject to tax in Nigeria. And that means that kind of product will constitute significant economic presence in Nigeria. Now, there are some activities that are carried out by a non-resident company that will not be treated the way we have treated the first one. Because the first one, we are treating them as company and observing the tax in Nigeria as company. But this other one, where a company provides professional service, consultancy service, management service, and technical service to a Nigerian company. Okay, such a company shall be subject to tax only using the withholding tax of 10%. So 10% is what they are going to be charged. So, and that will constitute the final tax liability on that income. That will constitute the final tax liability on that income. Any question before we move ahead? . Any question? In the absence of none, we move straight to effect of 2021 withholding tax on non-resident company. Now, especially with regards to turnover. So we are saying where a non-resident company with with a digital significant economic presence in Nigeria has made income in Nigeria, and we are unable to access this company to tax because probably the company did not file its returns in Nigeria because it's not a Nigerian company. We don't have the financials, but we know the amount of sales this company has sold. We know the amount of turnover they have generated in Nigeria. So we are saying that such a company shall be assessed to tax in Nigeria. Now, how do you assess such a company to tax in Nigeria? This is an anti-tax avoidance measure introduced by federal government, introduced by the tax authority to curb any form of tax evasion. And therefore, that means any income that is being generated through these digital means will be subject to tax in Nigeria because, number one, the company has not been able to show us its financials. That's number one. Number two, the company has not been able to also tell us that they made income. They've told us they did not make income, or the income that this company makes, or the income that the company makes is less than expected. Such a company, therefore, shall be subject to tax using the fair proportion of the income. Okay, fair proportion here is not stated. It could be 20%, it could be 10%, it could be whatsoever percentage that the tax authority wants to examine. So that is that. So we'll quickly go on to the next subtopic, which is relationship between Nigerian company and the branch and the parent company. Relationship between Nigerian branch and the parent company. Now, just like I said the other time to you, there is relationship between Nigerian company and its branch. Okay, so a branch company is seen as a subset of the parent company. Is seen as a subset of the parent company. Therefore, they are seen as one entity. GTB, for example, as a bank, has a branch in Lagos, has another branch in Kaduna, does not mean that they are going to be assessed to tax differently. We are going to access the two of them, the two companies, or wherever the branches are, we are going to be seeing them as one company. So whether you have branch in Lokoja, you have branch in Kafansha, you have branch in Kano. So all those branches will be seen as part of the head office. And in terms of tax liability, they are going to be subject to tax alongside. So their profit is reported as one. So they are not seen as separate entity from the head office. So in terms of tax liability, they will be subject to tax as if they are one. Okay, that's that. The next one is relationship between a Nigerian company and its subsidiary. A Nigerian company and its subsidiary are not the same. They are going to be seen as different entities. A Nigerian company and its subsidiary are not the same. They are going to be seen as what? Different entity. So that will be subject to tax differently. They are going to be paying their tax differently. A subsidiary will pay its tax differently, while the parent company will also pay its tax differently. We are not going to be saying that they are paying their tax together. No. Do you understand? So their tax is paid differently. In terms of what the parent company will get from the subsidiary, the only thing the parent company gets from the subsidiary is the dividend, nothing more. So the subsidiary will pay its own tax, while the parent company too will pay its own tax. The next one. Relationship between overseas branch of a Nigerian company, overseas branch and that of a Nigerian company, Now, the overseas branch of a Nigerian company is also seen as part of Nigerian company. It's a branch. GTB has branch in West African countries, right? So in terms of taxation, you remember when we started this class, one of the things I told you was that the income of the taxpayer is on its global income. That is, it is not only subject to tax in Nigeria alone. Wherever the company has branches, such company would afterwards be accounted for such branches. So we have to pay tax on all those branches. However, you remember that where a company has foreign branch, it is possible that in that country that you have established your branch, the company would have also paid tax on the profits attributable to that company in that country. What we are trying to say here is that the company would also be allowed under the tax law to claim double taxation relief. However, the taxation that you're going to claim, your relief that you're going to be claiming shall not be more than the income tax that you're going to pay in Nigeria. That is that. Overseas subsidiary of a Nigerian company. They are not the same. They are just like an investment arm. Okay? They are not, for the tax purpose, they are not going to be treated the same way. They are not treating them the same way. So they are separate legal entity. They are what? Separate legal entity that will be subject to tax differently. However, what this company will be getting from the subsidiary company is the dividend, just like I've explained. You're only going to be getting dividend. Do you understand? So that is it. Any question? Any question? Any question? No question. We move to the next one. Filing of returns by a resident company. In terms of filing of returns, the Act provides that all companies must file their returns as and when due. Now, what is the due date for filing returns? The due date for filing returns is 6 months after the accounting year end. That is for a company that has been in business for so many years. For a company that has just commenced operation, the Act provides that the company must file its returns within 18 months from the date of incorporation and within 6 months or within 6 months after the first accounting year end, whichever comes earlier. That is what the taxpayer is expected to file in returns with. So, what are the contents of returns? What are the contents? What are the contents? Number one, the taxpayer must file its returns. And in filing returns, the content of your returns is your annual financial statements, audited financial statements, audited financial statements. The financial statement has been audited. You must submit it. Self-assessment form must be submitted. Your asset schedule must be submitted. And evidence of payments of tax liability to the designated bank must be submitted. Also, your capital allowance computation must also be submitted to the tax authorities. I hope you guys are jotting. Okay, and that is that. So I have said the company must file its returns. In filing returns, the audited financial statements must be filed. Number two, duly self-assessment form. Number three, total profit of the company upon which tax will be computed. Number 3. Number 4, fixed asset schedule. Fixed asset schedule. Number 4. Number 5, capital allowance computation. Number 6, evidence of tax liability paid. Evidence of tax liability paid. Now, having said that, according to 2020 Finance Act, a non-resident company is also expected to file returns now. A non-resident company is also expected to file returns. But what are they filing as returns? They also need to file their full audited financial statement that has all their income and the portion of Nigeria. Full financial statements that has everything and the part that relates to Nigeria must be filed and must be what? Attested to by independent qualified accountants. Tax computation based on profit attributable to Nigerian operation. The next one is a true and correct statement writing containing the amount of profit from each and every sources in Nigeria. A duly completed company's income tax assessment form. So that is that. I have told you of filing of returns. I said companies must file their returns within 6 months after the accounting year end. Where the company is just commencing operation, the company must file their returns within 18 months from the date of incorporation to within 18 months earlier, between 18 months and within 18 months from the date of incorporation and 6 months after the first accounting year end, whichever comes earlier. That is, if you are asked question on this, that what is the time limit for filing returns? You will state by saying, for an existing company, the company must file its returns within 6 months after the accounting year end, or for a new company, the company must file its returns within 18 months from the date of incorporation or within 6 months after the end of the first accounting year end, whichever comes earlier. Okay, so that is that. There is no exemption for anybody not paying tax and not filing tax returns. There is no exemption. Okay, so that is that. The next one is penalty for failure to file returns. A company that fails to file return within the first month of failure will pay 25,000. And for every subsequent month of failure, the company will pay 5,000. Now, where the tax authority is put on inquiry that the person that made the company not to be able to file returns is a principal officer in the company, whether it's the accountant, whether it's the financial director, whether it's the chairman of the company, that has made the filing of the return not possible. Such a person will be liable to a fine of 100,000. They will be liable to a fine of 100,000. And apart from that, the tax authority might be annoyed and say you are going to be in prison for 2 years for not filing your returns because you are the person that is in charge. So that is that. Any question? Okay. Since there is no question, we'll move on to the next one. I know you will ask questions very soon. I will leave you guys to read all this. We'll move on straight to calculation, because I think I'm boring you guys with my discussion. Okay, let's look at this question. Wealth Capital Limited is a stock broking firm registered to operate in the capital markets in Nigeria. It commenced business on July 1st, 2019. The company audited accounts have revealed the following. Periods ended 31st December 2020, 84 million. Year ended 31st December 2021, 94 million, 92 million. Year ended 2022, 10 million. The company did not file returns with the Federal Inland Revenue Service in respect of its accounts for the year ended 31st December 2020 until March 31st, 2022. You are required to, one, state the document required to be filed for tax return with the Federal Inland Revenue by the registered companies in Nigeria. You know that. I jumped this, but you will read it at home. Calculate the penalty payable by wealth for late filing of returns based on its accounts for the year ended 2020, for the year ended 2022. For the year ended 2020 to March 2022, I think. March 31st, 2022. So how do we go about that? Let's go. We know all this. I've explained this before. Just go ahead and look at it again. Okay. So let's go. The first month of default will be July 21st. You remember, we said this guy, when a company commences operation, they must file returns within 18 months. Abi? So within 18 months, this company must file its returns. So, and this company failed to file its returns as a well due. So the first month of default will be July 21st. July 31st, 2021. Because it must file its returns within 18 months. That is, within 18 months or 6 months, whichever comes earlier. Now, this guy will be given an opportunity to file its returns within 6 months after this period. So if he did not file it, he will be liable to a penalty. So this guy did not file within 6 months, even after this 18 months that this guy has commenced. So he will be liable to 5,000 in the first month of default, and we'll continue to count the remaining number of months from August 2021 to 31st 12, 2021. That is 5 months. And from January 2021 to February 2022, the guy did not file his return, so he will also be paying a penalty of 10,000 for those 2 months. So the total liability that this guy will be paying, the total fine that he will be paying is 60,000. You can read this at home. So the next one I'm going to be talking about is book of accounts. This was asked about 4 days ago, that explain book of accounts according to section 63 of CETA. It was just introduced in Finanza 2019. Now, what does this say? Every company in Nigeria is expected to have a book of accounts where they keep their transaction. You must have a book of accounts where you keep all your transactions. Is very important. Now, and this book of accounts must be maintained for a period not less than 6 years after the year of transaction. For a period not less than 6 years after the period of transaction. The book of accounts must also be kept in a language that is consistent with that of the government, which is English language. Any books of account that is not completed or kept in English language must be translated back to English language and must be certified by a sworn translator. Now, anybody that fails to keep his book of accounts in the first month of failure, when these books are required and you are unable to give the books to the tax authority, then you will be liable to a penalty of 100,000 in the first month of default and 50,000 in the subsequent months. So that is that. The next one is payment of tax liability. This is what we are going to do some work. Payment of tax liability. I think we did this last week.
A question, please.
Yeah.
So the first illustration we solved, you said the first month of default is July 2021.
Yeah.
I don't know. I'm calculating January 2021. 18 months from July 2019. The business started July 2019.
It should be it should be from January, not July. You get. So the company must file a return within 18 months. No. So you remember, we said within 18 months from the date of incorporation, from the date of incorporation, or within 6 months after the end of the first accounting year end. You get. So the reasonable 1 year that we're supposed to pick is within 6 months after the end of the accounting year end, because we are not even told when this company was incorporated. Do you understand? Okay. So that's why we have to take within 6 months after the end of the first accounting year end. So within 6 months after the first accounting year end would have been June. So it did not file. So that means July, we will start paying penalty. And that's what is obtainable in practice.
Okay. So, okay, sir. You mean is 18 months from the day of incorporation, not the day they commenced business?
Yes.
Okay. All right. Thank you, sir.
Thanks. So we move on to payment of tax liability. I think we did this last week or 2 weeks ago, I remember. So we talked about, I said there are 4 ways in which tax liability could be paid. You remember, we said in the class. And I remember Prosper was able to answer some questions I posed to the class last week. So I said the first one is tax will be paid by dividend. Dividend. That's number one. Tax will be paid on total profit. Tax will be paid on turnover, and tax will be paid on minimum tax. So we took the tax on dividend last week or 2 weeks ago, where I told you that the tax authority, section 19 of CETA, talks about assessing companies to tax on their dividend. Now, where and how would this occur? Now, we said when a company will be assessed to tax on its dividend, we are looking at some criteria. Number one is that the company has told us that there is no total profits. There is no total profits. Because there is no total profits, the company shall be subject to tax because there is no total profit. Number two, we said there is total profit, but the total profit declared is less than the dividend. There is total profit, but the total profit is less than the what? Dividend. Therefore, the company shall be subjected to tax on the dividend. However, Section 19 of 2 of CETA talked about some exemption for payment of tax liability on dividend. There are 4 exemptions. Number 1 is that where the dividend is paid out of retained earnings. Where the dividend is paid out of retained earnings, the dividend shall be exempted from tax. Number 2, where the dividend was paid out from frank investment income. And we also know that frank investment income is the income that is not subject to tax. So when dividend is from frank investment income, such is not taxable. Number next, we said where the dividend is from profit that is already exempted from tax. Profit already exempted from tax by the provision of capital gains tax and provision of petroleum profit tax. Such will be exempted from tax. We have also said where the distribution is from real estate investment company, such a profit shall be exempted from tax. Such a profit shall be exempted from tax. So that is what we have said. Now, those are the 4 situations where dividend will not be what? Subject to tax again. Now, however, there are some scenario questions that I've painted here so that we will look at it together and provide a solution to it. So, we said an extra from financial statement of retention policy limited for 2021 shows the following: 1.5 million loss, 1 million, 11 million profit, and dividend of 1.5 million. So, what are we going to do? In this case, are we going to subject the company to tax on its dividend? Are we subject the company to tax on the dividend? I haven't said that where dividend is paid from retained earnings, such a dividend will be exempted from tax. So, in this situation, are we going to now this company made loss? That means where would they have seen the profits that they would declare as dividend? They would have seen it from what? From retained earnings, right? Therefore, we are going to exempt this company from tax in this period because the dividend was paid from where? From retained earnings. Abi? So the company will not be subject to tax here on its dividend. The next one. Illustration 2. Who can tell me what will happen here? Prosper, look at the question and tell me what will happen.
So, the profit for the year is 11 million, and dividend paid is 15 million. That means there is a 3 million dividend from the retained earning, which is not supposed to be taxed.
4 million or 3 million?
Sorry, sir, 4 million, sir.
Good. So we are going to exempt the 4 million and
4
tax
million.
the 11
11
million.
million.
Okay. So that is that. The next one. The next one. Who is helping us out?
The 4 million. Sorry.
You said?
When are we exempting the 4 million?
The 4 million was from retained earnings.
Okay. Okay.
Because they would have declared this 11 million as dividend, right?
Yes.
So the remaining 4 million would have been taken from retained earnings.
Okay.
So
It's clear.
It's clear. Good. The next one. Oh yeah, you are the one answering this one. You have asked question. You must answer. Oh yeah, look at this next scenario and tell us what we have.
The 10 million is the difference, right? Because the profit is 52 million, which they were supposed to pay out as dividend and which was supposed to be taxed, but they declared 42. So the balance 10 million will be subjected to tax. I don't know if I'm correct.
Okay. Who else?
Sir,
Yeah.
the dividend should be subjected to tax
Why?
because it is not even up to the profits for the year. So it's taxable. It's less than the profit, or rather the profit, the entire profit should be subjected to tax, which is the
The
52
entire
million.
profit.
Which is the balance now?
The
Isn't
entire
it?
52 million.
Okay.
The entire amount should be subject to tax, right?
Yeah.
So 42 million will not be exempted from tax. Why?
Yes.
Because it was paid from the profits, not from retainings. Do you understand me? So that is that. We move on to the next one. CIT based on turnover. Now, this is also an anti-tax avoidance measure. It's an anti-tax avoidance measure. And why do the tax authority bring it into play? Now, the tax authority would have brought up this section because they noticed that the taxpayer usually come up with flimsy excuses that I did not make profits, or the profit they are declaring is less than expected. So taxpayer will come, imagine a taxpayer in the industry of oil and gas declaring a profit of maybe $10 million. They will say, Laila, it's not possible. You cannot be declaring a profit of $10 million with this your size. They will now go ahead and subject the taxpayer to tax on the turnover. Or you are telling us that you made 10 million as profits, dollars as profits. When we look at the other industry in the same category as your company, other companies are declaring 200 million as profits, dollars now as profits. You are declaring $10 million as profits. The tax authority will not take that because they will now go back to your revenue, your turnover, and look at your turnover and subject to tax on turnover on a fair proportion. So what we are trying to say here is that there's every possibility that the taxpayer's turnover, the taxpayer could be subject to tax on turnover. What are the reasons? Number one reason is that the taxpayer has said there is no accessible profit. Number two, there is accessible profit, but the accessible profit is less than expected by the tax authority. It is less than expected by the tax authority, comparing the taxpayer or comparing the taxpayer to the other taxpayer in the same industry. So the taxpayer would have to be subject to tax. So that's that.
I have a
And
question.
will be subject to tax on the proportion, fair proportion of his turnover. Ask the question.
Okay, so this situation, is it applicable to a resident company?
Both resident and non-resident now.
Okay, what's in a situation where there is an evidence, like there is a proof that this company actually made a loss and does not have profits for the year?
We will know now.
Okay.
Tax authority will know. I haven't done, when tax authority also comes to your office or during their tax audit, they will look at all your books and see if truly you have made loss. Now,
Yes.
if the tax authority accept that you have made loss and they leave this one, they go on to the next one. They will also check minimum tax liability. Irrespective of the fact that a taxpayer makes loss, there is also a provision in the tax law that talks about minimum tax. whether you make loss or not, you still have to pay minimum tax. Now, what is the minimum tax saying? You pay a minimum tax because you have not made profits, you made loss, or the profit that you made is less than expected, or the tax liability that you have computed is less than minimum tax. The company will be subject to minimum tax. I'm saying it again. A company will be subject to minimum tax based on the following reason. Number one, the company makes loss. Number two, the company says, I do not have total profits. Number three, the company's already calculated the minimum, because they already calculated the company income tax. And the company income tax calculated by the company is less than the minimum tax computed. Therefore, the company will have the minimum tax. So that is that. So that's number 4 that I talked about. So number 3 now is company to be assessed tax on its total profit. This is what we're going to be talking about: the type of tax liability, the rates at which the company will be assessed tax. Number 1, we said, now company will be assessed tax on its total profits. And what is your total profit? Your total profit is your assessable profits less your loss relief, add your balancing charge, and also take out your capital allowance. You have all the notes. So the profit that you have at this instance will now be what? Subject to what? To tax. Depending on whether the company is a small business, medium-sized company, or a large company. Now, where a company is a medium-sized company, how do you subject such company to tax? For a medium-sized company, we said they are going to pay 20% as their tax rate. Now, what is small company according to tax law? A small company is a company that has a turnover of less than or equal to 25 million. So if your turnover is 25 million, then 25 million or less, you are a small company. And by implication, such a company will not pay tax liability. Zero tax liability. Do you understand? Next is when a company is having a turnover that is more than 25 million and less than 100 million. The turnover is less than 25 million, but less than 100 million. More than 25 million, but less than 100 million. We will call such a company a medium-sized company. And this company shall be subject to tax at the rate of 20%. What about a large-sized company? A large-sized company is a company that has a turnover of over 100 million and above. 100 million and above. And the tax liability of this company shall be 30% of the profits. So, you'll be reading all this on your own. So I've talked about minimum tax. Withholding tax is tax that you'll be charged on the profit of the company. So it's going to be charged on the transaction of the company. And we say withholding tax is an advance payment of tax liability. Okay. Now the next one is payment of tax liability by installments. Payment of tax liability by installments. The tax authority gives the taxpayer a leverage to pay their tax liability by installments. Okay, they can pay their tax liability by installments. But in doing so, you must write to the tax authority and inform them that you want to pay by installments. Okay? And when you are paying, you must make sure that your final installments must be paid on or before the due date of filing. Everything, you must have paid it between the due date of filing. Now, what we are trying to say here is that if you are supposed to file and pay your tax liability 6 months after, and you will know that you want to pay on instrumental basis, you have rights to talk to the tax authority to help you pay your tax on an instrumental basis. To pay on instrumental basis. Okay? That is that. So, and you must ensure that when you are paying your tax liability, the final tax liability must be paid on or before the due date of filing your returns. So that is that. Now, according to the tax law, the Finance Act also introduced benefits of paying tax liability early. Benefit of paying it early. Now, if you are a small company does not have any benefit because they are not paying tax liability. But a medium-sized company must, if you pay your tax liability within 3 months, instead of the 6 months that we talked about, if you pay within 3 months, you have a tax rebate of 2% of the tax liability. So if you are supposed to pay, let's say you're supposed to pay 10,000 naira. So 2% of 10,000 naira is 2,000. So that's your rebate. To be deducted in next tax year, not this current year. So you have paid your tax liability early enough. So you can also take advantage of tax rebates. Okay? So for a small size company, you'll take 2%. For a medium size, for a large size company, it's 1%. That is, if you pay within 90 days, instead of 180 days, you'll be given these tax rebates. So that is that. So you are going to be reading all these profit exempted from tax on your own when you get home. So that is that. We are going to be discussing donation. Donation is an allowable deduction provided you follow the conditions. Number one, condition for donation is that donation must not be capital in nature, except if the company is donating to institution and university. So any donation made to financial institution and research institution is exempted from, is allowed, so to speak, is an allowable deduction. But if you make donation of capital nature to any other institution that is not university or research institution, it's not going to be allowed. Number two is that donation for any year shall not be more than 10% of the worth of the profits. Now, this could be more if you are making donation to tertiary institution or research institution. And this will mean it's, in terms of that, the donation should now be higher of 15% of the total profit or 25% of the amount of the tax payable, whichever is higher is what you're going to take. The next one is donation must be made to any fund or bodies or institution contained in Schedule 5 of CETA. So if you are making donation, you must make it to the what? To the bodies in this listed. We have a list of the bodies that when you make donations to, they are going to be an allowable deduction. Now, these are the bodies. Now, how do you also, if you cannot remember the bodies under examination condition, how do you test that this donation will be allowable? Number one, if the donation is of public fund, as in public in nature, you would have seen it is public. Not donation to political party, not donation to political party. But when you notice that it's of public funds, such will be allowed. Again, if the donation is to statutory bodies and institution, such will be allowed. The next one is to ecclesiastical, educational, or scientific institution. Such donation will be allowable. So that is that. When we come in the next class, we are going to continue from here. When we come in the next class, and I would want you guys to have read this material. I will send it to you so that we can have a very fruitful discussion in my next class. My next class with you will be Saturday by the grace of God. And by next week, Saturday, we are most likely going to finish this topic. If you are not able to finish it, we'll move it to the upper Saturday. But be rest assured that we are starting hydrocarbon tax from first week in April. If you cannot start this month, we are starting first week in April. I'm going to forward this material to you so that you can read it ahead of the class. Good day to you.
Yes,
Any-
good day.
Thank you so much.
All right,
So I have a question.
go ahead.
There is a particular question I was solving with a colleague. So in that question, an amount was mentioned to be donation, let's say 3,000 naira. And they went to the additional information to say that 1/5 out of the 3,000 was given to government for pandemic purpose.
Yeah.
Now, but in the solving, the person that solved the question now deducted, like now allowed the entire 3,000.
It's allowable. Because you know why?
Yes,
So during pandemic, there was a provision that was introduced in Finance Act to cater for this. So that is the next donation that we're going to talk about. It's part of the material I'm sending to you guys. So we'll look at it when we meet again.
Sir, excuse please. Like the total amount is 3,000. The mentioned 1/5 was for pandemic. So the remaining 1/5, is it automatically assumed that it was also for pandemic?
No, so the remaining one. So if you are given a question under donation and the examiner did not say anything with regards to whether the donation is for particular thing, you are going to allow the donation. Donation ordinarily is allowable. You get. But if the examiner does not want to allow donation, the examiner now give you further details. Do you understand?
Yes,
They
sir.
will now give further details. So that is when you are not going to allow the donation once you see further details.
Okay. All right. Thank you, sir.